Prediction markets and financial analysts are increasingly pricing in the risk of a U.S. military strike against Iran in the coming months, a development that has already begun to influence global energy markets. According to Eric Meyerson, Chief Emerging Markets Strategist at Skandinaviska Enskilda Banken AB, SEB, prediction markets now place a 71% probability on a U.S. strike occurring before June this year. This rising risk perception has contributed to a noticeable geopolitical premium in oil prices, with Brent crude futures recently climbing above $70 per barrel. Meyerson warned that any escalation involving naval operations could significantly raise the risk of disruption in the Strait of Hormuz, a vital transit route for global oil supplies. Given the political and operational limits of a direct U.S. strike, he suggested that a more likely initial move would be a naval intervention aimed at restricting Iran's shadow fleet and sanctioned oil exports. Such a strategy, he noted, would increase the likelihood of incidents in the strait compared with last year's conflict. Market indicators support these concerns. Polymarket estimates place the probability of Iran attempting to close the Strait of Hormuz at 31%, up from 24% last June, while the oil VIX volatility index has risen to 55.4% from 43.2% a year earlier. Brent crude prices are now comparable to levels seen before last June's war, despite beginning the year from a lower base, and the entire Brent futures curve has shifted upward, signaling elevated long-term risk perceptions. Riston Energy echoed this view in a market update on January 29th, reporting that oil prices surged to $71.50 per barrel, their highest level since late September 2025, driven largely by speculation of an imminent U.S. strike on Iran. Ristad's head of geopolitical analysis, Jorge Leon, said markets are rapidly repricing geopolitical risk, with the speed of the price increase suggesting traders view U.S. military action as a real near-term possibility. J.P. Morgan analysts also highlighted the impact of rising geopolitical tensions, noting that gold reached a record high above $5,550 per ounce, while oil approached a 4-month peak. They warned that any strike or blockade involving Iran would occur at a particularly difficult time for oil markets, as the first quarter is typically marked by weak demand and rising inventories. However, this year has been atypical, with extreme winter weather in the United States temporarily shutting in up to 1.9 million barrels per day of production and boosting demand by roughly 0.5 million barrels per day. According to the U.S. Energy Information Administration, U.S. commercial crude oil inventories fell by 2.3 million barrels in the week ending January 23rd. While total petroleum stocks remain higher year on year, recent drawdowns, weather disruptions, and escalating geopolitical risks have increased market sensitivity, reinforcing concerns over supply security as tensions between the United States and Iran intensify. Supporting this assessment, Meyerson pointed to data from prediction markets and volatility indicators. Polymarket estimates currently place the probability that Iran may attempt to close the Strait of Hormuz at 31%, a noticeable increase from the 24% probability recorded on June 11th of last year. At the same time, the oil VIX index, a measure of implied volatility in oil markets, has risen to 55.4%, up from 43.2% during the comparable period last year. These figures suggest that traders are increasingly hedging against sharp price swings and supply disruptions tied to geopolitical developments. Meyerson also noted that Brent crude prices are now roughly in line with levels seen just before last June's war, despite starting this year from a lower baseline. He emphasized that the entire Brent futures curve has shifted upward more aggressively than it did in the lead-up to last year's conflict. This upward shift is evident not only in front-month contracts, but also in longer-dated futures, extending out as far as 12 years. indicating that markets are reassessing longer-term risk perceptions related to Middle Eastern supply stability. Similar concerns were echoed in a market update from Rystad Energy, sent to RigZone shortly before 3 p.m. GMT on January 29. In that update, Rystad reported that oil prices had surged to $71.50 per barrel within a matter of hours, reaching their highest level since late September 2025. The firm attributed this sharp move primarily to growing market speculation about an imminent U.S. military strike on Iran. Jorge Leon, Senior Vice President and Head of Geopolitical Analysis at Rystad Energy, stated that oil markets